The gold-silver ratio didn't just move, it snapped. For years, it sat at crazy highs, 80 to 1, 90 to 1, even over 100 to 1, quietly screaming that silver was dirt cheap compared to gold. Now, in a violent drop, that ratio has crashed back toward levels traders haven't seen in an entire investing lifetime. Call it a 70-year extreme, call it the deepest compression of the modern fiat era. Call it whatever you want. The message is the same. Gold is losing ground to silver, fast. And every time this has happened before, silver didn't just rally, it multiplied. That's why this video is called The Gold-Silver Ratio Just Hit a 71-Year Low. Silver's 10x Rally Has Begun. By the end of this video, you'll understand what the gold-silver ratio actually is, in plain English. The 3 times in modern history when extreme ratio moves led to explosive silver runs. Why this current collapse in the ratio is different and potentially more powerful than anything we've seen before. What a 10x silver move really means and what it doesn't. And how to position like an adult using the ratio instead of gambling on every candle. This is education, not personal financial advice. Use it as a map, then make your own decisions. 1. The gold-silver ratio, the most important number almost nobody watches. Forget the charts for a second. The gold-silver ratio is simple. How many ounces of silver does it take to buy 1 ounce of gold? If gold is $4,000 and silver is $50, $4,000 divided by $50 equals 80. That's an 80 to 1 ratio. For decades, when the ratio was very high, 80, 90, 100 plus, history said silver was dirt cheap relative to gold. When the ratio plunged very low, below 20 inches, 1,979, 1,980, history said silver had gone too far, too fast. Here's the key. The ratio isn't about predicting tomorrow's price. It's about spotting where the rubber band is stretched. Rubber band logic. Imagine gold and silver tied together with a rubber band. When gold races ahead and silver lags, the band stretches wide, high ratio. When silver rockets and gold can't keep up, the band snaps tight, low ratio. Over time, the band doesn't sit at one perfect number, but it doesn't stay at extremes forever. Each time it has hung at a high extreme, then snapped lower, or collapsed to a low extreme, then snapped higher, one metal has delivered life-changing returns. In the 1,970 seconds and in 2008, 2011, that metal was silver. Now we're watching the same rubber band snap again from over 100 to 1 at the start of this cycle, down toward the 70 seconds in less than a year. That's not noise. That's the beginning of a regime change. 2. The 3 great ratio crashes, and what silver did next. If someone tells you silver can 10x from here, your first reaction should be, show me when that ever happened before. Fair. So let's look at 3 times the gold-silver ratio went through a violent shift and how silver answered. Example 1. The 1,970 seconds. From 40 to 1 to under 20 to 1 in the early 1,970 seconds. The US ended the gold standard. Inflation went wild. People lost trust in paper. The gold-silver ratio started around the 40 seconds, 50 seconds, collapsed to around 16, 1 inch 1,900, and 79 1,980, one of the lowest readings in modern history. What did silver do? Early 1,970 seconds, around $1, $2 an ounce. January 1,980, near $50 in the blow-off spike. That's not a 50% rally. That's not a double. That's 20x, 30x, depending on where you start your clock. The ratio crash wasn't a random noise. It was the mathematical footprint of silver's repricing from forgotten metal to monetary panic valve. Example 2, 2008 to 2011, from to 80 to 1 to low 30 seconds. During the 2008 crisis, the gold-silver ratio spiked to around 80 to 1 as silver got crushed and gold held up. Then, central banks cut rates to 0. QE flooded the system. Investors started hunting for hard assets again. By 2011, the ratio had collapsed into the low 30 seconds. Silver had gone from under $10 in the panic to nearly $50 in the spike. Again, not a small move. That's roughly a 5x from the 2008 lows into the 2011 top. The ratio didn't predict the exact path. It simply told you silver is way too cheap relative to gold. If that gap closes, silver, not gold, will do most of the work. That's exactly what happened. Example 3. 2020, the spike nobody believed. In March 2020, the world locked down, markets crashed. The gold-silver ratio screamed to an insane 126 to 1, the highest reading in modern data. Translation: silver is being abandoned. Gold is the only thing anyone trusts right now. From that extreme, silver doubled and then doubled again over the next moves. The ratio crashed back down as silver outperformed. That was your first warning shot. When the ratio hits an extreme and then reverses, big moves in silver are not a theory. They're history, over and over again. 3. What just happened and why this is the big one. Fast forward to this cycle. At the start of 2025, gold was roaring to new highs. Silver lagged badly. The gold-silver ratio surged above 100 to 1, repeating the silver is trash, gold is king message from 2020. Then the rubber band snapped in less than a year. Silver doubled, more in some markets. The ratio collapsed back toward the 70 seconds, one of the steepest drops in living memory. On paper, analysts say, the ratio is still above its long-term average near to 60, so silver might still be undervalued. But here's what matters. The direction has flipped. The speed of the move is extreme. And structurally, the drivers are different from every past episode. In the 1,970 seconds, silver's surge was mostly a money panic story. In 2008, 2011, silver's surge was monetary fear plus QE response. This time, it's monetary stress plus structural industrial demand plus real supply tightness. The ratio isn't just saying people are scared of fiat. It's saying people are scared and the world physically needs this metal in a way it didn't before. That's the difference between a 5x move and a 10x cycle. 4. What 10x really means and what it doesn't. Let's get something straight. Silver's 10x rally has begun does not mean silver will go up 10x this year. Silver will go up in a straight line. There won't be savage corrections that shake everyone out along the way. What it means is the kind of conditions that produced 5x, 30x silver moves in the past are present again, in some ways even stronger. In the 1,970 seconds, the base was around $1, $2, the top near $50, 20, 30x over the decade. In the 2000s, if you were buying under $5 in 2001 and sold near $50 in 2011 10x, today's base? Not the $50, $60 you're staring at on the screen right now. The base was the decade when silver was suppressed in the low teens and $1.20 seconds, while the system quietly stretched the gold-silver ratio to absurd heights from that base. A move into and through triple-digit silver is 10x territory. A move that re-rates silver from forgotten commodity to strategic metal is structural, not a meme. Here's the key mental shift. The 10x isn't a promise from today's price. It's the life cycle of a suppressed asset repricing over a decade. You are not early to the chart. You are still early to the story. 5. Why this ratio crash is more explosive than the 1,970 seconds. So what's actually different this time? 3 things. 1. Industrial lock-in. In the 1,970 seconds, silver was used in photography, some industry, some jewelry. Important? Yes. Absolutely essential to the global energy and tech stack? No. Today, solar panels, electric vehicles, high-density data centers, medical electronics, communication infrastructure, defense systems, all quietly depend on silver's electrical and thermal properties. You can't just rip that out of the global system in 3 years because the price went up. That means a huge chunk of silver demand is locked in even at higher prices. Industries might hedge, might redesign over a decade, but they can't abandon silver overnight. In a ratio crash, that matters. When investors and industry are both pulling on the same limited pool of metal, the move doesn't stop because someone tweeted overbought. 2. Structural deficits. We're not guessing about shortages. In recent years, the silver market has run consistent deficits. Total demand is greater than mine supply plus recycling. The gap has been filled by drawing down inventories and above-ground stocks. In a high-ratio world, deficits are a warning. In a falling ratio world, they are gasoline. Because now you have gold still doing its job as a monetary anchor, silver outperforming gold as the tight little cousin that everyone suddenly wants. The ratio crash is the math catching up with that reality. 3. A more fragile, more leveraged system. Since the 1970 seconds, the world has layered on far more debt, far more derivatives, far more financialization of everything. The gold-silver ratio is dropping into a system where central banks are already stretched, currencies are already questioned, investors are already edgy. In that environment, shifting even a small percentage of global wealth into a tiny market like silver can create outsized moves. The ratio crash is your signal that this shift is not theoretical. It has started. 6. How to use the ratio like a grown-up, not a gambler. At this point, you have 2 ways to react. Emotionally, 10x, I'm going all in. Rationally, okay, how do I use this ratio to improve my decisions? Let's pick the second. A. Stop thinking in prices only. Most people see gold at X, silver at Y, and ask, is that cheap or expensive? The ratio asks, relative to each other, which one has more room to move? When the ratio was over 100 to 1, history said silver was extremely undervalued relative to gold. Now, as it collapses toward the 70 seconds and below, the ratio says the first leg of silver's catch-up has already happened. The big question is whether it just goes back to average to 55-60, or overshoots like it did in the 1970 seconds in 2011. So instead of, is $X silver cheap? Ask. At this ratio, does more upside live in silver or gold over the next 5-10 years? Right now, even after a huge silver move, the ratio still tells you silver has more room to run than gold if the rubber band keeps snapping.